Woo-hoo-hoo. Oh, boy. Go on and take the money and run. What a great song that was. Who knew that it would be such a comeback hit in these times? Go on and take the money and run. This is Dominic Samaroni, WTBQ 93.5. I just want to let everybody know that you're tuning in to the That's Where the Money Is. I have a guest today that's really going to be amazing. I just want to give you a couple of quick announcements first, and then we're going to go right to the guest. I don't think you're going to believe what you have to hear. But if anybody's driving or listening to my show today, look up the definition of validity or valid, because that's where the money is. That's where I'm going to be after this show. I got a quick announcement. Last weekend, my son Connor asked me if I would take him out to the Hamptons. So I said, why do you want to go out to the Hamptons? He said, you keep talking about the Hamptons on your show all the time. I'd like to see what it's all about. So I said, it's not a bad place. It's a great place. And there's great people there, and it's a good time. As a matter of fact, if I remember correctly, East Hampton is on the top 10 beaches in the United States. They have great sand. I don't know if they truck it in or not, but it's great sand out there. Love the Hamptons. He had a great time. He saw a couple of Ferraris, a couple of Lamborghinis, and, you know, there's nothing wrong with making money. There's nothing wrong with living large. It's how you made the money. That's where I have the problems. I don't have a problem with banks. Everybody's probably making a face right now, but I don't have a problem with banks unless you're not making money the right way. So that being said, Connor had a great time out in the Hamptons. We're probably going to go back out again. Like I said, nothing wrong with the Hamptons. It's how you got there. That's the way I was raised. Got a couple of announcements I'd like to make. Profits came in, second quarter profits for the big banks. Chase came in a little bit less than they were supposed to, but they're still coming in the billions in profits. Citibank, big profits for the second quarter. Wells Fargo, a little bit lighter than they hoped, but they had a lot of payout, a lot of fines. But if you look online on my website, wfsutton.com, you'll see I'm going to post the amount of fines that were paid to date by these top three banks where everybody deposits their money. I also want to talk about one more thing. With regards to foreclosure, foreclosure is getting tougher. It's getting tighter. The courts are caught up. The banks are caught up. It's not an easy road to hoe. So you really need to have a good team. You need to have a good lawyer. You need to have a good forensic guy. We had the forensic guy on last week. That was Steve Dybert. He's a great friend of mine. He's a great friend to our business. He's an important cog in the machine, and we have a lot of gratitude. He helps us break these mortgages down and help homeowners get a level playing field to keep their house. So just a quick foreclosure announcement there. I had a quick announcement about profits at the banks, and just a quick disclaimer. Like I said, I don't have anything against banks. There's great people that work at the banks locally here. There's friends of ours that work at the banks. I'm just not a fan of the way the banks made their money. Validity. That's how I started the show. I have a guest on today. She is an ex-employee of Wells Fargo. Her name is Beth Jacobson. I hope she's on the line. Beth, can you hear me?
Yes, I can.
All right, Beth. Nice to have you on the show. Thanks for coming on today. You and I spoke yesterday. We spoke earlier today, and we had a few things to inform people about. I kind of described the foreclosure debacle or financial collapse that everybody was affected by. You know, I had people ask me, well, how were you affected? It didn't cost you anything. Well, it didn't cost us anything, no. But the way they had put this whole plan together and the way they made their money and the way they got to where they got was not right. And when they fell and collapsed, we had to bail them out, which is fine also. I mean, we did bail out car companies also, but some of the things that they did, I would say, are criminal. Would you kind of agree with me on that term, criminal?
Absolutely.
Okay.
I agree with that.
Well, I'm going to introduce you, and I'm just going to touch upon some points that you and I had discussed. You're Beth Jacobson, and you're living in Maryland?
Correct.
Okay. And you worked for Wells Fargo for 9 years.
Yes.
And what was your position there at Wells Fargo, Beth?
I started out as a loan officer originating subprime loans. I eventually ended up building my own team. Wells Fargo opened an office for me, and I rose to the ranks of Wells Fargo to become the top originator in the country for subprime loans.
The top originator in the United States for subprime loans. Okay. Just to bring everybody up to speed, what is the definition of subprime loans? I've been doing subprime loans since 1984. What is the definition of a subprime loan for the layman?
Well, it's basically the opposite of a prime loan. So a prime loan is for somebody with credit scores perhaps 660 or higher, and then that they can fully document their income. The subprime loan, also known as the non-prime loan, the Alt-A loan, are for homeowners that either have some credit issues, can't show their income, maybe have had a recent bankruptcy, have a high debt-to-income ratio. Those people that don't fit right into that prime box.
Okay, now
outside the box.
That was a great description. Thank you. And that prime word term is I guess a derivative of meat in the USDA and the government branch of the meat inspectors, and they categorize meat as prime meat. Or USDA grade prime A, grade A prime beef. And the type of loans that Fannie Mae, Freddie Mac, and not necessarily FHA, but Fannie Mae, Freddie Mac did grade A good loans, I would say. Wouldn't you say, based on their underwriting criteria, their guidelines at the time?
Based on the guidelines, there's certainly an argument that when they were
they didn't all get there like that, yeah.
Yeah.
Some of them got a AAA stamp. A couple of cows got a couple of AAA stamps that shouldn't have. So,
right.
Yeah, and fell into the grinder. So,
I like your analogy because the meat, that's kind of like just how these banks sell the people. They weren't real. It's just a piece of meat here, and this is how we can make money off of them.
Yes, and we're going to talk about that. The subprime loan market where I came from, when we did subprime loans, it was just like writing insurance. I'm the king of analogies, as people say, but we wrote loans like insurance brokers write insurance. There's high-risk insurance and there's low-risk insurance. You have a good driving record, you're insuring a low-cost car, and you're of age, and you took a driver ed class, hopefully, you're going to probably pay a lower rate. If you have a Ferrari and you're 16 and you had a DWI, you're probably going to pay slightly higher than everybody else. It's a higher risk, higher rate. So the loans that I wrote were sold to private companies. They weren't sold to private individuals. If they were securitized, they were securitized and sold as subprime loans, higher yield. But we also cut back the LTVs, as you probably remember. That's the way it used to be. You cut back your loan to value, you cut back your loan size, and you graded the loan interest rate wise based on the risk factor. Am I pretty correct with describing what a subprime pricing and category is?
That's correct. Although, ironically, at Wells Fargo, you could have a credit score as low as 580 and get 100% loan to value.
That's right. Now, what they did was, which there's nothing wrong with a bank doing subprime loans if they're underwriting them as some subprime loans. These loans that you did over the last, 3 or 4 years of your tenure at Wells Fargo were subprime loans, but written under the guidelines of prime.
Well, they were subprime loans, and they were written under subprime underwriting guidelines. Wells Fargo separated the prime and the subprime.
Okay.
And so they may have been sold on the secondary market
as prime.
Alt-A.
Mm-hmm.
Which when people see Alt-A, you assume it's a prime loan.
Right.
But they were the underwriting guidelines for the loan officers. These were true subprime loans.
Okay.
So they may have been repackaged and sold as A loans.
Okay, and these loans, I guess, I had a conversation with someone about banks, and we talked about how the banks were forced to make certain loans to certain minority groups and to open up the floodgates and give these loans out. This was a perfect storm because now you have Wall Street who's buying, I hate to say it, but buying junk. The investors didn't know about it, but they were buying junk. 401ks were going into these loans. You were explaining to me on the phone, who's buying these loans on Wall Street when these loans are being sold and packaged and securitized?
Well, at Wells Fargo, at least, the loans were actually pre-sold to a pool. So similar loans would be put in a pool. Maybe there'd be 2,000 loans in a particular pool, maybe in a similar geographical area. Then they're sold to what's called a sponsor, which is set up as another corporation, and then they're sold to a depositor, which is another corporation, and then ultimately sold to the trust, where you get that long name and maybe 2006-123. And then ultimately,
the securities instruments.
Right. And it's not really the loans that were sold to these maybe pension funds. It's the stream of income.
The security.
That was supposedly supposed to come out of these loans, with the homeowners paying so much, their mortgage payment, so much of that money was then supposed to be passed through to the people or the
pass-through securities
that purchase these at the other end of that. But they set up so many different, the sponsor, the depositor, all to protect the originator.
Right.
In fear that the people that ultimately bought these would find out it's a bunch of junk and start suing
Wells Fargo and everybody else.
Which is starting to happen now.
Well, yeah, I see those lawsuits coming through. What is this, our 7th year, 8 years since this all went down, and people are just figuring it out. They could have called you or I, and we could have told them that's where the money is, or was, or should have been. But you said you had to use the great term, set up. They set up. They set themselves up. They set up the investors. It wasn't necessarily Wells Fargo or the banks. It seems that they were getting their orders from where the money was, and that was down on Wall Street. Wall Street couldn't get they had an appetite. They just couldn't get enough to fill. Exactly.
That's what we were told as loan officers, is it's what the investor's appetite is at that particular moment. For a while, investors were really hot on investment properties. And so then Wells Fargo would change the underwriting guidelines so you could purchase an investment property with only 5% down, but the income and the assets were never verified, just solely based on a credit score.
And the investors had no idea what they were buying into. They were buying into these streams, pass-through securities.
Exactly.
So it wasn't necessarily the big bank's fault, per se. Except for pushing for the volume and stretching the guidelines.
I would say a part of it is a big bank's fault because I'll give the example of Wells Fargo. Wells Fargo's goal for the subprime division was to pay for the fixed cost of the whole company. And that's, office space, secretaries, all of that, those fixed costs.
Mm-hmm.
And so with a company that large that's covering just about in every single state, that's a huge amount of money. And so to have those fixed costs paid by the subprime division, there was a lot of pressure on the loan officers and the managers to close subprime loans.
Right.
And so if you were in the subprime division, you had quotas. You had to close at least 3 subprime loans per month or you were fired.
Right.
So if you're sitting there and you're reaching the end of the month, and as you know, as a loan
the numbers
officer,
aren't there.
As good as the
last
that
sale
month that you're in.
That's right.
Doesn't matter what you did last month.
Nope.
All that matters is what you're doing this month. So
right.
if that person walks in the door with an 800 credit score, a W-2'd employee, you're going to do your best to put them in a subprime loan. You're going to convince them you need to go stated because stated income
quicker,
it's
faster, you close right away, less red tape, and you pay a little bit extra freight. So now, talking about volume, I want to lead you into the volume, and I want to now talk to you as soon as we come back from the break about the loans that you made in certain neighborhoods where you had the big push. We're right back.
Okay.
The talk about the F word for a minute, foreclosure. Defaulting on your mortgage can cause a lot of stress on you, your family, and most importantly, your kids. As soon as you default, your banker sends your file over to their legal department to begin the foreclosure process. In the old days, you called every family member possible to borrow money, or you rented a U-Haul and left in the middle of the night. Well, not anymore. Now you could turn your banker's files over to your legal department, the law offices of Stephen Stutman. If you have a foreclosure problem, Stephen has the solution. Are you aware that there are many options available from your bank, the state, and the federal government? The law offices of Stephen Stutman has successfully represented their clients for over 30 years. Steve Stutman doesn't work for the banks. He works for the people and defends families' homes. So, if you are interested in keeping your home, then call Steve Stutman at 888-574-7771. When it comes to the roof over your head, Steve Stutman's got you covered. 888-574-7771. This is an attorney advertisement and an offer of assistance. Attorneys cannot guarantee results for either side.
If sun damage or aging is stopping you from looking on the outside how you feel on the inside, then come to the Hudson Valley Cosmetic Surgery and Skin Center. The board-certified physician and trained, compassionate staff provides skin rejuvenation treatments that will take years off your face and neck with very little or no downtime. With 25 years of experience and state-of-the-art innovative procedures such as eyelid rejuvenation, Botox and Restylane, chemical peels, and laser treatments, look as young as you feel. Call Hudson Valley Cosmetic Surgery and Skin Center for a free consultation at 877-956-2792.
Come and be part of the celebration at the Warwick Valley Farmers Market every Sunday from 9 a.m. to 2 p.m. Pick up locally grown farm fresh produce along with locally raised beef and poultry and bison. Choose from a variety of cheeses, honey, maple syrup, herbs, soaps, and even flowers. Our farm kitchens and bakeries offer a wide variety of breads, cookies, cakes, jams, and jellies every Sunday from 9 a.m. to 2 p.m. Located on South Street, 1 block from Main Street.
Hi, this is Austin Du Bois of Bluestein, Shapiro, Rich, and Barone. Tune in every Friday at 10 a.m. for It's the Law and learn what the law is. Ask questions, get answers right here on WTBQ, radio worth listening to.
Hey, it's your turn to speak up. I'm Zach Kruk, the host of Speak Up, where you voice your opinion on issues affecting us in our nation and in our community. Speak up and call in every Wednesday at 10 a.m. on WTBQ, radio worth listening to.
WTBQ.
Okay, that's a serious song for a serious subject. Like I said, I don't mind how you got to the or that you vacation in the Hamptons. It's how you got to the Hamptons. Here's the deal. We're gonna talk real quickly about volume with Beth. Beth, tell me about the push for volume and how you, I hate to use the term on the air, but became a whistleblower for Wells Fargo and how you had to increase volume in certain areas. Are you there?
Can you hear me?
Now I can, yeah. Go ahead.
Okay. At Wells Fargo, as I said, there were certain quotas on how many subprimes that you had to originate. So Wells Fargo as a company was always looking for different areas to get into in order to originate more loans. So at least in the Maryland area, what Wells Fargo did, in particular in Baltimore City, was target the African American churches. Meet with the minister.
So you would go to the African American churches to make a push for volume. That was their business strategy. Now there's people that deposit money in these banks, and there's people that invest in these loans. There's people that have stock in these banks. And you're telling me that you were part of an operation and became a whistleblower for a settlement also, you had told me earlier?
Correct. And I just want to be clear that it was Wells Fargo that it was actually a business strategy to market to the African American churches. However, I was not part of that because I am white. And Wells Fargo was very specific that they wanted African American people to sell loans to African Americans.
Okay.
That was their business model.
And how much was the settlement that they made the deal with the government for being pinched, I guess you could say, or being picked up for this, for pushing loans on African Americans?
There was $175 million.
So they settled for $175 million.
And of course admitted no wrongdoing, and it was based on reverse redlining.
Well, there's definitely no wrongdoing. That's why you pay $175 million out to the government. There's no wrongdoing. You just write a check. It's $175 million. Now,
Exactly. And it started with a lawsuit that Baltimore City sued Wells Fargo based on all of the foreclosures in Baltimore City and all the row homes, which were predominantly African-American homes. I met with the attorney that was representing Baltimore City and explained what Wells Fargo was doing, how they went into these churches and basically sold their loans, and Wells Fargo failed to inform the church members and the ministers of the church that these were all subprime loans.
Okay. Another question. What part did you have? Did you testify in court? Were you in federal court?
Actually, it was just my affidavit, which is publicly available online, as to what Wells Fargo did. So based just on the strength of my affidavit, Wells Fargo came to the table with DOJ and settled.
Okay. We had a caller call in before. I don't know if he wants to call back in, but you were so entrenched in just enlightening the listeners about Wells Fargo's business plan. What year was that business plan? When were they making the big push into those neighborhoods and giving loans to these unsuspecting borrowers?
It would have been approximately 2003 all the way through 2007.
Okay. And these loans were subprime loans?
Correct.
Whether they had good credit or not.
Exactly. And then part of the pool that would get the ministers of the church in, for every loan that Wells Fargo funded, whether it was a refinance or a purchase, Wells Fargo would donate $350 to the church.
Oh, man. Oh, my gosh. You got to be kidding me. And I have friends that work at banks, and they say, why do you bash the bank so bad? Why do you bash the bank so bad? That's not a community idea to me, or an idea of a community investment. The Community Investment Act, I guess, of pushing mortgages on people in certain colors and ethnicities. That's not a business plan to me. I don't own stock in that bank. I'm glad I don't, even though their stock is doing just wonderful. You don't have to be a depositor in that bank to own stock, and you don't have to, own stock to be a depositor. That's why I push so much for credit unions. When we do foreclosure defense and a client comes to me and says, I'm in foreclosure, I need help, I think, okay, I'm ready. I got my fireman's jacket on. I'm going to talk to Steve. We're going to talk about the problems with the loan. We're gonna get everybody involved, and we're gonna try and get this thing resolved for you. And then they say, I have a loan with a credit union. What do you think when you hear credit union?
Oh, those loans are actually vetted, and I work with local banks here in Maryland where they will actually work with the homeowner.
Yes.
When the banks here locally, these small local banks, including credit unions, when they say we don't want the house, they actually mean it. When Wells Fargo, Bank of America, Chase say we don't want the house, they're lying.
I know.
They physically don't want the house, but they want the house.
They want the money. They got to swap the money out, right? Now I have I got a caller that's calling in. Has a quick question for us. I guess while we're on the air here. Hello, caller. Who are you? What's your name?
Hey, it's Joe.
Hey, Joe.
What should happen to Franklin Raines, the head of Fannie Mae, who set all this in motion, where Fannie Mae, a federal government organization, quasi-government organization,
right,
put all these goals there, and he got bonuses for the more subprime loans he got. It's not just the banks. The banks were forced into this by the government, by Bill Clinton starting subprime lending in 1990. I mean, to just, and I'm not going to support banks, but they pushed them to make these loans to people who are in the inner city.
So your question basically is, what about him? What about the guy in charge of Fannie Mae who just received a bonus? How much was that bonus? I read that it was
millions of dollars.
It was millions, right?
Millions,
he got millions of dollars in bonus money. Yep. I've said it from the beginning. This was a college frat party. Everybody in the house was guilty. Everybody
know what? At the end, though, here's the problem. The government made the policy. The government punished the banks for their policy. What were they going to say?
They're all part of the game. You're 100% right.
The hen house.
I'd like to make a comment on that.
Yes.
Go ahead. It was for the Community Reinvestment Act.
Yes.
CRA, right.
Yeah, CRA.
Community
Real Estate.
But let's be clear. That's separate. That was separate money. Those were supposed to be prime loans that went out there.
That's right.
What happened is the bank got greedy, and they saw this population that was underserved. They were underserved because there were not banks in the inner city is one of the reasons they were underserved.
Not everybody, guys, should own a home.
You're
know
100%
that.
right. Not
You
everybody.
know
And that's
that.
why God invented apartment buildings. And on that note,
Take care, guys.
Hey, that was a great call, and thanks for calling in. And Beth, I got to make my show longer. That got heated. I'll talk to you again, Beth. You're going to come back on the show.
Sounds great.
It's great
Looking
talking to you.
forward
Thanks for everything.
Thank you.